So the topic is interest rate risk management. And first of all, we need to discuss that what is the meaning of interest rate risk with the business contacts. What risk we faces with reference to interest rate. Like foreign exchange, we face the risk interest rate. Foreign exchange value increase or decrease. Like this, in the business context, the interest rate risk we face is as a borrower. For example, what the risk with respect to the borrower? It's very simple. If we need to borrow money after some time, what will be the risk as a borrower? Interest rate will increase and we will get a loss. But do remember that, for example, in this scenario, we need to borrow $100,000 sometime in future, say after 3 months for 6 months. So we have a time. Sorry, 2 months. We have a time of only 2 months to protect the increase in interest rate and the loss for the next 6 months. In case of the lender, if we need to lend the money, what will be the risk? If for example we have a spare fund after 2 months and for the time period of the 4 months, so what will be the risk? The risk will be that the interest rate will decrease and we will get the loss. So in a simple term, as a borrower, we have a risk interest rate increase. As a lender, we have a risk that interest rate will decrease. Second thing, borrowing or lending, it's non-marketable and marketable. This is what the point you already know that. Whatever we have discussed in above example, that is about the non-marketable. And we will discuss later about the marketable debts. We will discuss later about the marketable debts. But I just want to initiate it. As a borrower, your mind should be specific. What is the risk? Our risk that when in future we are going to borrow the money, interest rate will increase. Number one, simple. Number two, do remember one thing, and you have to know that this point very simple, that any listed company has two options to borrow the money. Simple, to the bank, that is non-marketable, or issue the bonds to the public. When there is a point to borrow from the market, that means issue the bonds. That means we need to issue the bond. So, for example, again, being as a borrower means company wants to borrow money from the market and wants to issue the bonds. So, what the company wants? Company wants that after 2 months, we will issue the bond with a certain percentage. For example, today the rate of interest is 6%. Company wants that after 2 months, we want to issue the bonds with same 6%. But what is the risk? The risk is that if during 2 months time period, interest rate will increase, for example, switching 6 to 7%. So after 2 months, if interest rate will increase, for example, 7%, and we want to issue the bonds with same 6%. So actually after 2 months, if interest rate will increase, our bonds with the 6% rate value become decreases. And with respect to your previous studies, you know very well about it. Value of bonds and interest rate having inverse relationship. If interest rate increase, value of bond decrease, and vice versa. So we can say one thing in two manner. What is the risk of the borrower the risk of the borrower is that interest rate will increase. Number one. Number two, same point. If interest rate will increase, the value of the bond will be decreased. But the same thing with respect to the lender. Lender position with, for example, you want to lend money. After 2 months, you have a spare fund of 70,000 and you wanted to lend money to the bank. This statement is non-marketable debts. But in case of the marketable debts, again, 2 months time, 70,000 spare and you want to invest in the bonds. For that means you want to purchase the bonds. You want to purchase the bonds. Then what will you say that if you wanted to purchase the bonds? As a lender, what is the risk? Lender has only one risk. Interest rate will decrease. For example, today the lending rate is 5%. After 2 months, you will get the money. You have a risk that what if the interest rate will drop from 5% towards downward, whatever, 4.36, 3%, whatever. But same thing in a marketable term. If interest rate drop and you have an hawk eye of bonds in the market which are providing the interest of 5%, but in the market interest rate will drop in 2 months. If the market in the market generically interest rate drop and you want to purchase same 5% bonds, then after 2 months the value of that bonds will become increase. So I repeat, lender 2 points but same meaning. Risk, interest rate decrease. Marketable terms, if interest rate decrease, value of the bonds increases. So that is what we discussed at initial points only. At initial points only. Candidates, we will specifically discuss initially only about the borrowing aspects. Only about the borrowing aspects. But later on, we will discuss in more detail about the lending position as well. Okay? Okay, let's move on. Number one, we have just discussed the point that what is the interest rate risk, but we haven't discussed how to manage it. Now, interest rate risk management. Interest rate risk management. Number one, internal strategy. First point is netting. And number two is smoothing. Number two is external. External strategy. And what are the external strategies? FRA, forward rate agreement. Interest rate guarantee. It's basically FRA option. Same OTC. Interest rate options, sorry, interest rate futures, marketable. Interest rate future options. This is also marketable. Callers. These are the possible strategies, internal and external. First of all, quickly discussion of the internal strategies. That is netting, smoothing. That is the point, huh? Netting, smoothing. Listen carefully. Before discussion about, oh, sorry, netting, it's very simple. The term netting. You have an interest rate exposure. What exposure? 3 months after, you have to borrow $100,000 and you have a lending $30,000. So it's very simple, candidates. Net borrowing $70,000. It's so simple. Netting is only one condition. Timing will be the same. Candidates, simple interest rate exposure has no complication of codes. Has no complications of codes. I repeat, interest rate exposure, simple interest rate exposure, having no complications of codes, direct and indirect. Simple boring lending. But for netting, only the timing are same. 3 months borrowing, 4 months lending, never netted. It's not possible to net. Number two, smoothing. For before understanding or before discussion of the smoothing, you all know very well one thing with respect to your earlier studies of the F9. With respect to the earlier studies of F9, huh? Listen carefully. What? You can borrow at fixed on the and floating. You can borrow the money at a fixed rate or floating rate. I think so. You know that what is the difference between fixed and floating? I hope so. I hope so. Fixed and floating. Fixed means, for example, if you borrow the money with a fixed rate, so it will not affect if the market rate of interest move. For example, I'm giving you an example of long term. Huh? For example, you have borrowed the amount for 4 months with a 7% fixed rate. So in 4 years time, in 4 years time, if the interest rate fluctuate in the market, it will not hit it to the fixed rates. For example, interest rate move to the 6, 7, 8, 9. So your 7% is fixed. Okay. Floating means you will borrow the money LIBOR plus spread. Spread means percentage, 1%, 2%, 3%. Floating. Fixed rate, floating rate. So you must have to know that in case of the fixed or in case of the floating. It's not matter, huh? Floating, you have a risk. What risk? If the interest rate moves increasing, you have to pay more. But listen this statement very carefully. Either fixed, either floating. In both cases, there is a risk. For example, if you fix the rate of interest 7%, so positive thing is that if more than 7%, you will pay the 7%. But there is a chance of loss, that is risk. What if the interest rate will drop? If interest rate is drop, then fixed is not worth for you. So there is a risk in the fix as well. Huh? Same as the floating. Floating, there is a risk that interest rate will increase, but the benefit itself. But in both cases of the borrowing, fixed or floating, there's a risk. Same case, lending. You can lend the money by fixed rate or floating. LIBOR minus spread. It's not plus. LIBOR minus spread. But what is the meaning of smoothing? Candidate, listen carefully. It's a common sense little bit, huh? Smoothing. For example, borrowing 4 months, 100,000 borrowings, fixed, and 4 month, $60,000. Both are borrowings, floating. If these two are netted off, that's called smoothing. Try to use your mind. Smoothing means the case of borrowing are netted between fixed and floating. That's called smoothing. And same case in the case of lending. The lending fixed floating are netted off. That called smoothing. Gentlemen, ladies and gentlemen, it's very simple. 100,000 fixed. The risk is that interest rate will decrease. 60,000 floating. The risk is that interest rate will increase. So common 60,000. Common smoothing of 60,000. Huh? Common 60,000 are netted off between fixed and floating. The netting off between fixed and floating is called smoothing. It's your F9 studies. It's not the part of the P4. It's F9 studies. Both that netting and smoothing. You can read from the book as well. Huh? Done. Now, these two things now going to discuss here. These two things. Now listen carefully. Candidates, your attention is required. Smoothing is not 40. The common amount is the smoothing. Huh? So net exposure, smoothing 60,000 and interest rate exposure become 40,000. Now 40,000 need to hedge. Now candidates, listen here. The case of borrowing. The case of borrowings. Listen here. For example, interest rate exposure. What is the interest rate exposure? Assume that now 1st January 2018. 1st January 2018. ABC company wants to borrow $70,000, $80,000 after 3 months for 6 months period. So it's very simple. The impression should be in your mind that 1st January 18, after 3 months, sorry, I'm going to change it. After 2 months, 1st March 2018, and for the time period of 6 months. Do remember, you have only 2 months. You have only 2 months to protect the 6 months interest. To protect the 6 months interest, this is the most important thing. You have only 2 months to protect the 6 months interest. Now listen carefully. Spot is 5%, 6%. And FRA, FRA means forward rate agreement. FRA, 4%, 7%. Do remember one thing in interest rate. No direct and indirect code. We have already discussed. BR, borrowing rate, always higher. LR, lending rate, lower. This is principle, rule. This is rule. This is universal. This is the case of borrowing. So spot borrowing 6%, FRA borrowing 7%. It's universal. Borrowing, it's universal. Okay. So what is the risk of the company? The risk of the company is that spot is 6%. And what is the risk of the company? The risk of the company is that interest rate will higher. At what date? Now standing is this, this arrow, 1st January 18. What we have a risk that, and now these are rates. Okay, and actually bank has offered, 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% 6%. 100% Bank has offered this 7% FRA. So a requirement, evaluate the situation. If estimated spot, situation 1, situation 2, 8% and 5%. Candidates' basic rule of interest will not be challenged. We are here to discuss about risk management and transferring the risk, like we discuss in forward rate in forex or futures in the forex. If we are going to transfer the risk, means insured our car. That means either car will be lost or accidental or not, our situation will be indifferent. Means if now the rate of interest 6% and estimated spot has become 8%, it means car is now get hit it, accident occur, the protection will be made by FRA. And if interest rate become decreased, that means car not hit it, everything is safe, in fact no accident, but you will have to pay the premium, your situation will be stable. So what we will do, number one, solution. First point, a banking terminology, FRA, we want 2 months after 6 months loan. So that is 2-8. 2 months after 6 months loan. That is 2-8. If 3 months after 9 months loan, 3-12. 5 months after 4 months loan, 5-9. So it's a banking term. So we can say that the FRA is 2-8. Number two, number two, situation analysis. Number one, if estimated spot 8%, means number one, as you must have to remember that spot market is different and FRA is different. So we will go to the spot market and we will go to the spot market and get the rate of 8%. FRA settlement. What we will say with the FRA settlement? In case of payment, we have bet with the 7%. We betted with the 7%. But actual happened with the 8. So that means 1% gain. This is gain. And in this gain payment, in case of gain, we will receive, and the effective rate has become 7%. But what if estimated spot become 5%? This is whole F9, huh? We are talking about F9. You will go to the spot market, get the loan 5%. FRA settlement, betted with 7% minus 5%. So in this case, actually loss happen. And this is a legal binding contract. We have to adjust, that is payment. 2%. And then effective interest rate 7%. This is the case. I hope you have recalled all the things of the F9 till now. So I'm not asking that is that clear or not, but you should have to recall as per uh, this as per my lecture, huh? Okay, adding on one thing, number one, candidates do remember one thing. In case of FRA, listen here, FRA exam solution, no need to work out a detailed working for this. If examiner asking you about this situation and asking that how much will need to pay, by FRA, you just pick this rate, 7%, because the answer will definitely 7%. You don't need to work out a complete scenario. FRA exam solution, simple. You will say that 7% into 6 over 12 multiply by the value of 80,000. 80,000 into, 7 into 6, that's 28,000. 2,800. This one is the solution. This is the exam solution. This is the exam solution. Second important thing, in the practical world, the Alhamdulillah, excuse me. In the practical world, the calculation is not work in that manner, because we will not go to the spot market and pay only 8%. We will pay 8% into 6 over 12 into 80,000. In the practical world, we will not receive 1%. We will receive 1% into 6 over 12 into 80,000. And then the amount become 2,800. and then we calculate the percentage of 7%. Same case for this. But in the exam question, the percentage values are perfect. It's acceptable solution. The whole of the interest working we will attempt with the percentage. It's acceptable solution. The whole of the interest rate risk management working we will work out according to interest. But forward, this working you maybe ignore, and this you have to do this one only. I mentioned that exam solution. Okay. Another important thing, candidates, listen here. Listen here. This is FRA. I wanted to add one thing in this question. Same above case, but interest rate guarantee. IRG, interest rate guarantee. Interest rate guarantee. And this means FRA option. FRA option. FRA option. What does that mean? In FRA, you are legally bound. In case of gain, you have to pay it. In case of gain, you have to receive. And but in the case of loss, you have to pay out. It's a legal binding contract. It's a legal binding contract. But what if? But what if the case, the option, you don't like loss? Okay, FRA option. FRA option. So in option, definitely if you wanted to get rid from the loss, you have to pay a premium. You have to pay a premium. For example, examiner says in this question, same this one scenario, this one is the scenario. Same this one is the scenario. But what I say that premium of 0.2%. Do remember one thing, in case of option, there is no option of the loss. So what will be the case, candidates? If you attempt this one, so I will say that situation 1, estimated spot become 8%. So we will go to the spot market 8%, and we have already paid the premium 0.5%. We have already paid the premium, and interest rate guarantee settlement only for gain. You betted for the 7%. Yes, minus 8%. That means 1% is the gain, and effective interest rate will be 8 plus 0.5 minus 1, 7.5%. But in case estimated spot become 5%, so can you please calculate and reply me? Yes. Spot market become 5%. Yes. Premium you have already paid, and interest rate guarantee settlement nil, because you have lost it. It's option lapse, and the answer is 5.5%. Tell me one thing, is that clear, all of you? Can you please reply me, is that clear, all of you? It's estimated spot, Abna. It's 5%. It's simple. If estimated spot become 5%, it's simple, 5%. Estimated spot. Is that okay, Amna? 5% estimated spot. Premium paid 0.5%. But interest rate guarantee nil. Okay. No, Shadab, this topic is not hard. As compared to Forex, it's comparatively easy. Because of what? There is no conversion matter. Two reasons for what interests are uh, less harder than, or less complex than Forex. Number one, hedging structure already developed. Number one. Number two, no direct and indirect codes. So, with your fresh mind, we will discuss details on tomorrow, inshallah. So, two things you have to consider it. Before starting the session, I have shared Forex is easy. So there are two possibilities for this. If you are saying that Forex is easier, either you are so intelligent or my lecture delivery is very good. I think first option is more appropriate for you. Okay. Candidates, before starting the session, I have shared document with you. Huh? I've shared a document. I again shared it. Huh? So what you should do that, you have to read what you should do. You have to read 1, 2, 3, 4, 5, 6, 7, 8, 9. Yes. Yes. The assignment is read first pages of the document. First document. And attempt example 1 and 2. first 8 pages of this document, not now, but tomorrow, and must attempt example 1 and 2. Okay, this is the first thing. Number 2, tomorrow session timings 8:30. Sorry, in fact, I will start with 9 to 1:30. Yes, that is the tomorrow's class timing. Uh, okay, I'm ending today's session, but there are two conditions required. Number one, you have to read and attempt the question. Number two, I want your uh, very specific and sharp mind for tomorrow. Specific and sharp mind. Because candidates, if you ask me that which one is more important for this session, either forex or interest, it, examiner can examine both of the things, no matter it is. But I'm very much confident that examiner will definitely ask something interest in this semester. Yes, examiner will definitely. It's definitely. Um, I'm sure. I'm very much sure. I'm not guarantee you, but I'm very much sure. So your sharp aspects is very much important. Next thing is that um, I will announce 2 extra session for coming week. Hopefully for between Monday to Wednesday. That is Tuesday and Wednesday. So for the timings, I will share by tomorrow, inshallah. So thank you very much. Take care a lot and good night. Allah Hafiz.